Hey everyone, and thank you for listening to this week's episode of the Saving Your Future podcast. The podcast based on my book, Saving Your Future, a step-by-step guide to wealth development. On this podcast, we talk about all aspects of saving for a successful future, including setting up a rainy day fund, saving for a car, saving for a house, and most important, saving for retirement. On this week's episode, we're going to talk about the importance of whether or not you need a bank account for a rainy day fund, or if you can simply have other investments that will cover that. So the answer to that is, the short answer at least, is it really depends. So we'll get into what the long answer is. When it comes to a rainy day fund, that's basically setting up money in case something bad happens. So maybe the car breaks down, maybe you need a new tire, maybe something hits the house and isn't covered by insurance, whatever it might be. Something comes up that you say to yourself, I hadn't really planned for this, and it's going to take a significant amount of money, whether it be a couple $100, a couple $1,000. It's something I wasn't expecting. I have to cover this expense. So many people suggest that you have anywhere up to 6 months worth of money set aside, 6 months worth of salary set aside to cover something like that. One of the things that could happen is you could lose your job, and what if it takes up to 6 months to find another job? Well, you want to be able to afford to pay your bills and all your expenses, obviously tightening the belt a little bit during that time, but you want to be able to not derail your entire financial future because of a situation like this. So many people say that you should just create a savings account and put the money into a savings account. Now, that sounds like the easiest, and it definitely is. Is it necessarily the wisest? Well, if you think about the fact that savings accounts now are making well under 1%, not even 0.5%, putting money into an investment might make more sense. Now, that considered, you want to look at where the investment might be, and usually a situation that requires the use of a rainy day fund isn't something that you can plan. So the ups and downs, or the pluses and minuses associated with having investments as opposed to having a savings account, is something we'll delve into a little bit. So let's talk first about the pros of the savings account. Well, even though the return is very small, it's very liquid. Having a savings account is the most liquid form of finances you can have outside of putting it under a mattress or something like that. If you needed the money tomorrow, you can just tap into that bank account, go to your bank and just make a withdrawal. Of course, if it's more than 10 grand, then you have paperwork and some hoops to jump through. But other than that, you can easily take out the money in little notice. You can even shut down a bank account if you have to withdraw all of it. As we mentioned, the downside to it is such a low rate of return. So essentially, the money in the bank account is theoretically, and we'll get into this in another episode, is theoretically losing money, because unless inflation is lower than the amount that you're earning in interest, you're really losing money. That said, is the peace of mind of knowing that money's there when you need it, whatever amount that might be, worth the fact that you're not really making money on it? And depending on your situation, the answer is yes. Now, on the flip side, you can take that same amount of money and just put it into a investment. You might put it into a CD, which results in a significantly higher rate of return. The downside is that CDs generally require 3, 6 months, or maybe even a year, so it wouldn't be as liquid. You couldn't take it out the next day. You might say, well, let's just throw that money into some stocks. And that could be a good answer, because let's say, for example, you put it into a stock like Verizon that pays a 3.5%, 4% dividend. You're looking at that dividend as well as any capital appreciation that could potentially be returning significantly more than a bank account with way less than 1%. The only downside to that is timing. You never know when you're going to actually need that money, as we discussed before. So let's say you're in a situation where you need that money today, and today is a time that the stock market just dropped by 800 points, as it did a week ago from the day that we're recording this. So what would happen if you took your money, let's say it was $10,000 of money that you put aside, and you threw that into Verizon stock? You're hoping that it does really well, but your $10,000 happens to be worth $7,000. Well, you know it's going to turn around and come back, but the problem is you need it today. So you have to pull out that $7,000, resulting in a $3,000 loss. So the true answer here is, what is your comfortability? What is your level of comfort saying I'm willing to take the risk of losing money knowing that I have a significant upside? Does it have to be one or the other? No. It could be a balance between the two. You could take a certain amount of that $10,000 and invest it in various stocks. You can even look at certain stocks that go the opposite way depending on whether it's a bull market or a bear market. And you can also look at balancing some of that $10,000 in maybe bonds, some of it in stock, and some of it in a savings account. The question really comes down to, what is it that you're comfortable doing? So the bottom line is, ask yourself what level of security that you feel that you need, and make sure that you set up your financial investment with respect to your emergency fund accordingly. If you have plenty of funds that you can divide them up and know that you're comfortable in the worst case scenario, again, they recommend at least 3 to 6 months of salary to cover any kind of expenses in the case of the worst case scenario of losing a job. So I'd love to hear from you and understand what your thoughts are. How do you set up your rainy day fund? Or maybe better yet, potentially you may not be where you would hope to be, but ideally, how would you want your finances structured with respect to your emergency savings? The goal is, if you aren't there yet, start saving now. Put even a small amount away every single paycheck. Maybe even to the point where it's a little bit painful. Maybe you're staying home instead of going out and enjoying something that you're looking to do. But knowing that you won't suffer catastrophically in the case of an emergency that comes up is definitely well worth it. So if you don't have 3 months, 6 months saved, start creating that fund today. And if you do, how do you feel is best for you to balance this? Are you comfortable taking the risk, putting it into an investment, or would you prefer to put it in a bank account and just know that that cash is there when you need it? Personally, I'd say a balance of the two. And again, it depends on your risk comfort level. So thanks so much for listening, and we'll see you in the next episode. This is episode 19, so we're about to turn the corner to 20. Look forward to seeing you then, and definitely subscribe to this podcast so you hear future episodes when they come out. Thanks, and have a good day.
Eventually, it's going to happen. You'll turn the key and your engine won't start. Don't lose your ability to get around. Visit O'Reilly Auto Parts for a Super Start battery. Whether it's a reliable economy, hard-working premium, or powerful extreme, you'll find it at an everyday low price. Don't let a dead battery slow you down. Visit O'Reilly Auto Parts. Better parts, better prices every day.
O'Reilly Auto Parts.